So hello traders and welcome back to our YouTube 2024 mentorship. And today I want us to look at how you can be able to grow your Forex trading capital because I have always encountered a question on like how much amount of capital do I need for me to be able to start trading? And then there are also other traders who say that you always need a very maybe big trading account, okay, or with huge capital, so that you can be able to succeed in Forex. But now what happens if you cannot be able probably to afford, let's say, like 10,000 USD? Because yet it's true somehow, because you find that those traders that have big amount of capital, they tend to trade less, meaning the lesser you trade, the more profitable you'll become. But now in this module, I'm going to teach you how you can be able to slowly grow your capital. Let's say you're starting from, let's say, like a small amount of capital, $100, $200. So I'm going to show you how you can be able to compound that slowly, so that you can be able to accumulate some substantial amount of trading capital with time. So key concept covered in this module, the power of compounding. So you're going to look at the power of compounding. We're also going to look at the importance of compounding your trading capital. How to take advantage of compounding in Forex trading, importance of risk management in context to compounding, practical ways of compounding. Okay, so I'll show you a practical way that you can be able to utilize or to be able to measure your progress in terms of compounding. So when we talk about compounding, basically compounding interest, as Albert Einstein says, that compounding interest is the eighth wonder of the world. So he who understands it earns it. He who doesn't pays it. Okay. So we have seen investors like Warren Buffett and among other investors, they have been able to take advantage of compounding interest, and we have seen their capital grow substantially, but it took time for them to be able to grow their capital, right? So one thing that you need to understand when it comes to the power of compounding, we want to talk about the exponential growth. You need to understand what we talk about when you talk about the exponential growth. So when you talk about exponential growth, let me go back to the slide. When you talk about exponential growth, basically you need to understand that compounding interest leads to massive growth of capital. You can be able to grow your capital massively. So as interest earns on both the principal and also the accumulated interest, the overall growth trajectory becomes steeper with time. Okay, so it needs to take time for you to be able to experience this exponential growth. And you find that now this is where most of the Forex traders miss it, because they want what we call instant gratification. They want, like, for instance, trade deposit $100, and by the end of the day, they'll have made, like, let's say $50 or even double that account. Okay, so they want instant gratification. And like I've always told you, in Forex trading, this is not a get rich quick scheme. If it were, everyone could be rich. Okay, so you need to understand that it will take you time. Okay, even as we talk about this compounding interest, it's not a one-off thing. It will take you some time. So you have to be disciplined. You have to be patient. So when you talk about the snowball effect, you need to understand that this is an effect that is created, especially in compounding, where the initial investment or savings start to gather momentum, and the rate of growth accelerates as time goes on. So you find, as you keep on trading, compounding your account, so your capital will be increasing as well. So meaning that as your capital increases, then you can also be increasing your position sizes gradually, so as to fit your account balance. Then, like I said, time is key. Time is very key. So the longer you allow your account to compound, or the longer you compound your account, the more powerful the effect becomes. So time is very critical. factor here in terms of maximizing the benefits of compounding. So it will take you time, okay? It will take you time, maybe a year, 2 years, 3 years, for you to be able to compound to a substantial amount of capital that you feel, now this is the capital that I need. That, for instance, you only need to take one trade on a weekly basis and you are done with your monthlies, because we have such kind of traders, because they have huge capital amount of money. So also you need to understand that you need to understand the long-term benefits. Okay, you need to understand the long-term benefits. And when you talk about long-term benefits, these are the benefits of compounding, which are often more pronounced over the long term. So consistency is consistent in contributing or reinvesting over an extended period of time amplifies the wealth building effect. So with these long-term benefits, let's say, for instance, you begin with $200 account and then you start compounding that account slowly. Let's say maybe you get some money, some extra money. When you get some extra money, this does not mean maybe you get an extra money from somewhere. It does not mean that now you can start living luxuriously, So for me, I would prefer, how I do it, if I get an extra amount of money somewhere that it was not budgeted for, what I do, I deposit it in my trading account. So I'll be able to increase my capital gradually. And you find that now this will bring long-term benefits in terms of trying to achieve my trading goals, or the amount of capital that I want to compound, so that I can be able now to trade freely, or maybe probably if you want to achieve financial freedom. Okay. So importance of compounding your Forex trading capital. Why should you focus on compounding your Forex trading capital? Okay. So one of the things that you need to understand, like I said, it will take you time. Okay, it will take you time. So with time, you need also now to be able to achieve some of these advantages, or whatever you're talking about. Okay. So in terms of one of the importance of compounding your Forex trading account is maximizing returns. Okay, maximizing returns over time. So you find that over time, compounding maximizes the returns on your trading capital. So the longer you allow your profits to compound, the more significant the impact on your overall account balance. So the other reason, or the other importance of compounding your Forex trading account is wealth accumulation. Remember, the goal is to attain maybe financial freedom or financial stability. So compounding will be a very powerful tool for wealth accumulation. So by consistently reinvesting your profits, you can steadily grow your trading capital and work towards achieving your financial goals or your trading goals. Then another importance is automatic portfolio growth. So compounding contributes to the automatic growth of your trading portfolio. So with each successful trade, your account size increases, allowing you to take larger positions and potentially generating more profits. Also, we have risk mitigation as an importance. So compounding can help mitigate the impact of losses. By reinvesting profits, you can recover from losses more effectively. As the larger your capital base grows, this allows you to absorb setbacks and continue growing. Okay, so you find that compounding is a very critical aspect of risk mitigation, because the more you compound, then it means the more you can be able to absorb maybe the losses that you'll definitely be incurring in the market, because not all days will be blue days. So it's a very critical aspect, okay, of risk mitigation. Then there is the long-term consistency. Okay, so consistent compounding will promote long-term trading success. So it encourages disciplined approach in terms of trading, and also it discourages impulse decisions that may jeopardize your capital. Okay, it helps you to avoid making those irrational decisions that may be able to jeopardize your trading, or maybe probably make you to incur some unnecessary losses. So Another importance is faster recovery from drawdowns. Okay, so in the event of drawdowns or losing streaks, you find that compounding allows for a faster recovery, because the larger capital base enables you to recoup losses more efficiently when profitable trades are executed. Then we have the psychological gains, or what we call the psychological benefits, and you'll find that compounding will provide psychological benefits by reinforcing a positive feedback loop. Therefore, successful traders will contribute to successful trades will contribute to increased confidence, which can positively impact your decision making process. Then the last importance is long-term financial freedom. So compounding is a key factor in achieving long-term financial freedom. So by consistently reinvesting and growing your trading capital, you increase the potential for generating substantial income from your trading activities. Okay, so these are some of the importance. Okay, they are not the only importance, but these are the key importance of why you should be looking at trying to compound your trading capital. Because if you're trading with $100 account and you're withdrawing each and every day, you find that sometimes you can make losses, the trade will go against you, at times you'll blow that account. So compounding will help you in terms of trying to see exponential growth over time. It will also help you accumulate your profits, so your account will grow, and this will now trickle down to the risk mitigation and also the psychological gains, which are very important, by the way, in terms of trading, because like we said, trading is 90%, it's 60% psychology. Okay, so how to take advantage of compounding in forex trading. So how do you take advantage of compounding in your forex trading? Because at the end of the day, is that we want to see our accounts grow significantly over time. So it's very important for us also now to take advantage as a trader. It's very key for you to take advantage of this compounding aspect in terms of your forex trading, so that you can be able to grow your account significantly, and also so that you can be able to achieve maybe certain financial goals, maybe financial stability, financial freedom, financial security, etc., etc. So you need to understand that compounding interest can be a very powerful tool for steadily growing your forex trading capital over time. And how now do we take advantage of compounding in forex trading? So number one, we take advantage of compounding in forex trading by reinvesting profits. So reinvesting your profit is very core principle of compounding. So instead of withdrawing all your gains, consider reinvesting them back in your trading account. So this allows your capital or your account to grow significantly or exponentially. So in terms of reinvesting capital here, maybe I can clarify that it's good again not to reinvest everything or not to compound everything. So if you have like maybe for instance you can come up with a plan that works for you. Let's say maybe from the profits you make, the 100% profits you make, you can decide that maybe you are going to pay yourself 20% and then you reinvest maybe 80%. Okay, so that means that at least you're feeling good when you pay yourself. At least you can see, you can take something out of the market, go and buy yourself, treat yourself well, treat yourself with a very nice lunch or dinner, buy yourself a nice shirt or maybe something that you want. You'll feel good when you see yourself with that particular thing. So it's always good to pay yourself, because it's a business like any other business. Always ensure, even though you're plowing back all the profits or investing back all the profits, again, consider the aspect of like maybe you can work with percentage. So you say like you reinvest 80% and then 20% you'll be able to pay yourself. So the other way is by increasing position size gradually. So you find that as your trading capital grows, you can gradually increase your position size. So this means that your profits and even losses. Remember, Forex, you look at it in two ways. Your profits and losses will be based on a larger capital base, leading to potentially gains over time. Okay, to lead to potentially gains over time. So the other way is by consistent returns. Okay, so aim for consistent and realistic returns on your trades. So while it's tempting to chase high returns, consistency is key when compounding your capital. So you need to avoid excessive risk that could wipe out your gains. Okay, so don't over leverage, be consistent. If you're growing your account 1% on a daily basis, the moment you achieve 1%, close those trades and wait, maybe for instance the next day. So consistency, and don't over risk in terms of trying to shorten the process. So if you've given yourself 4 years, don't try to do it in 2 years, don't try to do it in 1 year, because the moment you try to do that, you find that you'll be increasing your risk. Okay, so which can potentially wipe out your gains, especially when you scoop some losses, because you'll definitely have some losing trades or some losing streaks. So the other way is risk management. Like I've said, risk management is very important. Okay, so implement a strict risk management practice to protect your capital. So you need to understand, even though compounding can accelerate your gains, it can also amplify your losses if proper controls are not in place. So you also need to take care of the risk management. Remember the rule of thumb: do not risk more than 1 to 2% of your account per position. And if you are shooting for maybe, let's say, 10 pips stop loss, if you're risking, let's say, 10 pips, then you can always aim to make like maybe 20 pips in terms of profit. That gives you a risk to reward ratio of 1:2, which is a profitable business at the end of the day. So the other way is by diversification. Okay, so diversify your trading portfolio to spread risk across different currency pairs. So this helps in minimizing the impact of a single losing trade on your overall capital. So let's say, for instance, you are trading, you trade majors. Maybe you have a trade on Euro USD. So you'll want to avoid to open another trade for GBP USD, or maybe even USD JP, or any other currency that has USD. Try as much as possible to avoid that, because the moment you have like 2 trades or 3 trades and they all have USD, they have all USD currency, then it means you are over risking, or you have over invested in the USD. So, and in case we have maybe negative news that might affect your trades negatively, you find that you might lose in all those trades. So if you have maybe a running trade in Euro USD, then maybe you can consider doing another currency pair that does not have Euro and that does not have a USD. Maybe you can consider CAD JPY. Okay, so that's what we are calling diversification, and it will help you in terms of minimizing the risk. Then the other ways by avoiding over leveraging. Okay, so you need to understand like that while leverage can amplify profits, it can also increase the risk of significant losses. So it's a double-edged sword. As much as it's amplifying your profits, it is also amplifying your losses. So you need to avoid over leveraging. That is, you use leverage cautiously and avoid over leveraging your trades. And this can because in case you have losing streaks, or you have a losing trade and you have over leverage, these will definitely wipe out a huge chunk of your gains, and you find that now you're again on the drawing board trying to start all over again. So the other key issue is to stay disciplined. Okay, so discipline is very crucial when compounding your capital. Stick to your trading plan, avoid emotional decision making, and be patient as your capital grows over time. Then there is the periodic withdrawals, like I said. So you need to understand that while the primary goal is to reinvest profits, consider periodically withdrawing a portion of your capital gains or of your profits to enjoy the fruits of your trading labor. This can also help you maintain a balanced approach to trading. Okay, so as much as you want to achieve maybe your goal within a shortest duration time possible, or within a time a possible times maybe a time span of, let's say, 4 years, you can consider as well withdrawing some gains, and you find that this might yet extend your plan maybe by a year, but again you are getting something out of it. Okay, you are withdrawing something out of it, you are paying yourself. So this tends also to increase your morale in terms of trading. So the next thing that we're gonna look at is the importance of risk management in context of compounding. Okay, so how important it is, how is it important, okay, for you to be able to exercise risk management in context of forex trading, in terms of compounding, because we said when you are compounding, um, risk management is very key. Okay, risk management is very key, that we want to ensure proper risk management such that we do not find ourselves losing unnecessarily because of maybe probably opening huge positions. So one importance of risk management in context of compounding is preservation of capital. Okay, preservation of capital. And before I even talk about preservation of capital, when you talk about risk management, you need to understand this is very crucial. And especially when you're compounding, because you find that your capital will be growing over time. So you might want to ensure that even though you're increasing your risk, you are still increasing your risk gradually within the bracket of 1 to 2% per capital. Like we said, do not risk more than 1 to 2% of your capital per every trade. Okay, so risk management is crucial in the context of compounding your forex trading account. So while this compounding can lead to exponential growth, it also takes it also comes with inherent risk. Okay, there are risks involved. And you'll find that now, because we have risks involved, effective managing this risk is essential to safeguard your trading capital and ensure suitable long-term success. Okay, so the importance, one of the importance is capital preservation, or preservation of capital. So the primary goal of risk management actually is to protect your capital. By limiting the amount of capital risked on each trade, you minimize the impact of losing trades on your overall account balance. So like I said again, the rule of thumb is do not risk more than 1 to 2% of your capital per every trade. So the other importance is mitigation of drawdowns. So drawdowns, or what we call periods of losses, are inevitable in trading. They will definitely happen. There is no way you can have 100% winning streak. So proper risk management helps mitigate the impact of these drawdowns, allowing you to recover these drawdowns more quickly and continue compounding your account. So the other importance is consistency in performance. Okay, consistency in performance. And you need to understand that consistent risk management contributes to consistent trading performance. Okay, so by adhering to predetermined risk limits, you avoid impulsive and emotional decisions making that can negatively affect your trading results. Then we have the long-term sustainability, and effective risk management is crucial for the long-term sustainability, because you want to sustain yourself in the long term, okay, also of your trading activities. So it ensures that you can continue compounding your capital without risking significant losses that could jeopardize your ability to trade. Then we have emotional controls. Okay, emotional control. So risk management helps control your emotions during periods of market volatility. So knowing that you have in place a well-defined and limited risk management plan, this allows you to trade with a level head and avoid making decisions based on fear and greed. Okay, so it helps you especially in terms of emotions, because we have seen emotional trading can be very costly, because if you trade emotionally, you might tend to make irrational decisions, you over leverage, you fear, or even you can be fearful in terms of trying to execute trades, especially when you have lost a lot. Now you become your confidence is you become underconfident, so you tend to fear even executing trades. You can see this is the correct setup, but now because of emotions, you have fear, you end up not even executing that trade, and it ends up being a profitable trade. So the other reason or importance is adaptability to changing market conditions, and markets can be dynamic, and the conditions can keep on changing. So sound risk management practices allows you to adapt to changing market conditions without compromising your overall trading strategy. So the other reason again avoiding over leveraging. So we have talked about how you can be able to avoid over leverage. So compounding gains may tempt traders to increase leverage to accelerate growth. So risk management will help you to prevent over leveraging, which can lead to sustainable or substantial losses and the erosion of your capital. So if you practice proper risk management, we are saying that it will help you avoid substantial losses that could erode your capital. So definitely you have losses, but now because of risk management, they'll not be substantial. They'll not have a big impact on your trading. Okay, they'll not take away a huge portion of your trading capital because this is a mitigated risk, right? So the other thing is position sizing. So determining the appropriate position size based on your risk tolerance is a key element of risk management. So this ensures that each trade has a proportional impact on your overall capital, helping to maintain consistency. So this will help you to maintain consistency. Then we have protecting your profits. So you need to understand that while compounding involves reinvesting profits, risk management helps protect those profits, and therefore setting stop loss orders and trailing stops so that you can be able to lock your gains and prevent giving back profits during market reversals is very essential. Okay, it is very essential for you as a trader. Then risk management will help you avoid big losses. Okay, so you'll find that without proper risk management, a series of large losses could lead to catastrophic consequences of your trading account, meaning that you lose a lot of capital unnecessarily, and you can even end up blowing your account. So protecting against such events is essential for longevity of your trading career. Then the last thing is that you need to be disciplined and controllable. Okay, so it's discipline and control. So risk management will foster discipline and control in your trading approach. It ensures that you are making decisions based on a structural and thoughtful process rather than succumbing to impulsive actions. Okay, rather than succumbing to impulsive actions. Therefore, you need to understand that risk management acts as a protective shield for your trading capital when compounding. So it will help you to navigate the inherent uncertainties of the forex market while avoiding while allowing your capital to grow over time. Okay, while allowing your capital to grow over time. So let me show you an effective way or a practical way that you can be able to compound your account. So this is the daily compounding calculator. You can see the link. You can just copy that link and you'll be able to access this calculator. So how I do it, maybe I can show you from the beginning. So I'll go to Google and then I type compounding interest calculator. Then I come to this calculator here, compounding interest calculator, the calculator site. Then when I'm there, then I'll come to daily compounding. Remember, we are compounding daily. So I'll come to daily compounding. So in daily compounding, I'll choose the currency is dollar, or you can choose whichever currency that you're trading with. And then maybe I can choose, let's say I want to begin with $200. Okay, that's my principal amount. So I want to compound my account 1% daily. That is on a daily basis. I want to ensure that I compound my account guided by the 1%. Okay, so let's say, for instance, 1% of 200 is $2. Okay, so you can see that's quite achievable because it's $200 trying to make $2 on a single day. It becomes very much achievable. The first thing is that you're not overstraining yourself. Okay, remember we talked about setting smart goals. So it means the first thing, it means that you're not overstraining yourself. So you'll not tend to over leverage, because with this type of account, growing 1%, it means that you'll be risking maybe even 1% of your account. So the lot size to use here, you can definitely 0.01 and you shoot for 20 pips. Okay, so these 20 pips, if you are very in the beginner's level and you are not in a position to maybe get 20 pips per trade, then you can train yourself, like let's say to get 10 pips in London session, and then you get 10 pips in the New York session, so it becomes very easy. Okay, so meaning in the New York session, in the London session, you are looking to grow your account 0.5%, and then in the New York session again, you are looking to grow your account to 0.5%, so that at the end of the day you can be able to grow 1%. Or else, if you have a busy schedule, maybe probably that you don't have time maybe to keep checking the markets, or maybe to swing. If you're in a position you're not able to swing trade, then these can be very essential for you as a trader. Okay, so you do 200, let's say 200 compounding on a daily basis, and let's say now you take what, let's say you do it for, let's say 3 years. You give yourself a period of 3 years, and you are not trading all days of a week, because remember, we know we trade let's say we trade on Monday, Tuesday, Wednesday, Thursday, and Friday. So those are the trading days. And then let's say probably your investment rate or your reinvesting rate is 80%. Okay, so we said that you pay yourself 20% and then you reinvest 80%. So then now once you have those parameters set, you calculate and you see, so you can see exactly what you'll be having. So day one, you are shooting maybe, for instance, so this is showing on monthly basis, so you can go for daily basis. So it means day one you are shooting to make 1% of your account, so that will be 2.0 or $2. So you can take away maybe a portion of that, 80%. But daily basis can become tricky. It's always good to do withdrawals on maybe weekly basis. Okay, but this will give you a rough picture of probably the amount that you're estimating, because you'll find that this is your initial balance. So your investment value at the end of it all will be, you will end up making, if you scroll down all the way to this calendar, you can go maybe to the monthly time frame, so that you can, or the yearly, so that you can be able to see it clearly. So this means that in the first year, that is maybe 2024, these will be your earnings, and then these will be your cash out. Then these will be your balance. Okay, so 2025, these will be your earnings. Okay, so what you'll make, the profits, and then these will be your reinvestment, and this is the cash out. So this will be the balance that you start for 2026. So you find that at the end of it all, your balance will be $1,663.75. Okay, so again, with this calculator, the only option that this calculator does not show you is maybe those times that we have drawdowns, because not all day will be winning days. So how you factor this is that you have given yourself 4 years. Okay, so 4 years is what should you want to achieve this amount of money within 4 years. So this means that now, because of the losing days, you'll find that you can be able to achieve this maybe in maybe, let's say, 1 year. Okay, in 1 year, we assume that maybe 4 years are profitable and 1 year is a losing year. So you give yourself, now from this you can give yourself like a time span of 5 years, so that you can be able to achieve this particular amount of money. Okay, so remember, it takes time. This is not something that you can be able to do within a shortest duration of time. Compounding interest takes time. I'm not here to exaggerate profits, okay, or to exaggerate the way of trying to become financially stable quickly. No, remember, it takes time. And again, it takes proper knowledge for you to be able to do this trading, because if you don't have the knowledge, then even getting 10 pips on a daily basis will become a big problem. So it all begins with maybe trying to learn and understand how to trade Forex. And then it all trickles down to the trading psychology, which is the 60% aspect of it, whereby you have to be disciplined, you have to practice proper risk management, you have to avoid things to do with greed, you need not to be fearful, you need to trust yourself. All those things that comes under the psychology of trading, they attribute to 60% of your trading success. So you need to be cautious to factor them as well. Okay, so you can also even try this Forex trading calculator. Okay, this is a Forex trading calculator the same way. So this one basically takes control of those trading days that maybe on Saturday and Sunday. So you want to grow 1% on a daily basis, maybe let's do even 5 years. Then compounding, this is daily. So you can see daily compounding means interest rates compounded for the 365 to exclude weekends. Please use the daily calculator. So you can see this one, like I said, it does not factor the monthly. So it's always good. It does not factor the weekends. Okay, so it does not factor the weekend. So it's always good to use this daily calculator, because it gives you the option of days that you can be able to choose. You can see the days of the week. So if you say no, so it includes Monday, Tuesday, Wednesday, and Thursday, right? So that's one of the way that you can be able to track your compounding. Another way is by using these Excel sheets. This is not my Excel sheet. It's not me who developed this Excel sheet. So I take credit. I don't take the credit of this Excel sheet, but I want to give credit to the person who did this Excel sheet. Okay. But this Excel sheet becomes simple. It's automated. All the formulas have already been keyed in. So you only need to type maybe the amount of money that you want to begin compounding with, to start trading with, and maybe now the interest, the daily growth, 1%. Okay, so here you can adjust maybe the number of the take profit and the stop loss. Okay, so you can key in there. So you see, if we increase the stop loss, if we increase the take profit and the stop loss, you find that the lot size will decrease. So this is the lot size. So it gives even the correct lot size that you need to use, and also to give you your daily targets. Okay, so from here you can see that if, let's say, you are doing 200%, you want to start trading with $200 and you are growing 1% on a daily basis. So it tells you that you need to use a 0.01 lot size. So all the way to that particular level, you can see all the way to around, until you accumulate around 294. Then you can come all the way with 0.02. So one thing that this spreadsheet guides you is in terms of risk management. So if you follow it keenly, you'll find that no time that you'll be over leveraging, no time that maybe you'll over risking, not unless you go against the rules, because again, you can have the rules and again not follow them, right? So you see that at the end of the maybe 90 trading days, your account will have grown to $473. So someone might ask me, Timothy, this is so small amount of money. But let me ask you, there is no bank that you can maybe probably, or no institution that you can be able probably deposit $200, and after a period of 90 days, you come and meet that money has like doubled and some extra amount of dollars on top. Okay. So, but again, I'm not saying that maybe at the end of the 90 days, you'll be having this amount of money. You can be having less, but the key goal is your capital is growing over time, because there are days that you'll take losses. Okay. There are days that you'll have to take losses. So during those days, then it means by the time you are finishing the 90 days, you might not be exactly here, but you'll have achieved something substantial. Okay. So once you're done now, this maybe for, let's say, for instance, you close with $400. So you begin again 90 days. Okay. You do $400. So you'll find that at the end of another 90 days, you'll be having around $979. If you take, maybe you factor the winning, the losing days, let's say probably you'll have like 100, maybe 800. So you can begin now the other phase with $800. So you keep on adjusting like that until maybe it will give you a particular time of duration. You'll realize that probably maybe you'll need 4 years, 5 years to be able to have accumulated a substantial amount of money. Okay, so this is very important. Guys, what I'm saying is that if you don't have huge capital to trade like other traders, especially those that you see sending in screenshots, okay, of the profits they have made, one key thing is that they have big balances in their account. But for you, you don't have that amount to be able to deposit in your trading account. Then there is a possibility for you to be able to trade, to begin trading a small account. But now you have to be patient for you to be able able to compound that account so that within a particular duration of time, you'll have accumulated the capital that you desire to be in your trading account, such that now you'll not find yourself over trading so much. Okay, so one thing, the price that you have to pay here is the price of time. Okay, it will take you time. If you are a person who wants to see instant results, this is not the best option for you. Okay, so this will need you time. You need to take time, like 4, 5 years, 6 years, now depending on the amount of capital that you want to see yourself accumulate. Or maybe if your goal is to achieve financial freedom, then it will also take you time maybe to achieve maybe your financial freedom. Everyone has a figure of financial freedom. There is a person maybe who is looking at $1 million. There is another person looking at $500,000. So etc, etc, right? So ensure you follow these keenly. Don't over leverage. If you your key goal is to accumulate funds over time or to grow your account, so it becomes very, very effective. So thank you, and let's meet in the next episode.